Well, hello again. This is Lee Thurburn, and I want to welcome you back to another episode of Live Stream Lee, where we talk about business topics so that you can grow your business faster, become more successful, earn more money, retire sooner, and have more time with the family and the kids. So, today's topic is going to be a continuation, and hopefully we finish a four-part series on business funding and financing. If we don't quite finish, then we'll just carry over to Monday of next week. But I think we'll finish. Today's episode is sponsored in part by Bob Hurt. Now, Bob is a guy that is in the corporate swag business, and I have something to show you here. This is an apricot rocket, wonderful sports wiki t-shirt that is I got from Bob. These things are super comfortable and they look great, and he did a great job. Bob has been in the corporate apparel business for the last 50 years, literally the last 50 years. And nobody knows the corporate apparel and logo branded apparel business better than Bob Hurt. So I just want you to know that if by chance you're thinking about getting yourself some swag, you go to livestreamlee.com and click on the Bob Hurt button and get in touch with Bob. He will give you a great deal and make sure that you're well taken care of. Now, speaking of livestreamlee.com, I want to encourage you right now, stop what you're doing, pause this video if it's on record or if you're not watching it live, and go to livestreamlee.com and click on the Join My Community button and join the Livestream Lee community. When you do, you get a bunch of great benefits. You get an account on Apricot Rocket, which is a powerful digital marketing tool set. It's a CRM, shopping cart, lead generation, email marketing, text message marketing, just it does everything. Well, almost everything. It does a lot of great stuff, and it'll help you grow your business faster. But one of the benefits of having that account is that it allows you to get to the Livestream Lee community, where copies of slide decks and documents, private placement memorandums, subscription agreements, spreadsheets, all kinds of great stuff that you're going to find useful in your business. You can get them off of the community. But also, our whole purpose is to help you grow faster. And one of the ways we do that is we try to send you business. We try to introduce you to people that are looking for the kind of services that you offer. So when you create your account, you get the opportunity to tell us about your business, what services you offer and where you offer them and all that kind of stuff. So I highly recommend that you go to Livestream Lee and create an account. Now, if you decide you don't want it, you can quit the account. You can shut it off. It's free. So, just give it a try. See if we can't help you out. Love to do that. All right. So now I want to go ahead and move into our conversation about funding and financing your business. Before I do, a quick note, because I want to catch you early here. Tomorrow at 3 o'clock, April 16th at 3 o'clock, that's Central Time, we're going to be interviewing a guy named Bill Wallace. And Bill is a great guy. He started a networking group about 25 years ago called Success North Dallas. And it is without a doubt the preeminent networking group for high-level business networking in Dallas, maybe is in the whole nation. I mean, this is a great group. They meet once a month. Next week, he has a meeting. He's got an entrepreneur that wrote a book that's going to be his speaker, but we're going to be talking to Bill about how he did this. Look, building a long-lasting 25-year-long networking group is one thing. That's challenging enough. But building one that consistently attracts top-tier national corporate CEOs and people that are just in the celebrity sphere, Bill's done that. How did he do it? Well, that's what we're going to find out. So please join us tomorrow when we talk to Bill Wallace. All right. Now, let's go back here and let's go ahead and get started on the last part, hopefully. And if we don't have enough time to get it all, we'll continue next Monday. We're talking about IPOs now. We've talked about angel investors, friends and family, partners. We've talked about venture capitalists, and we actually started our conversation yesterday on IPOs. And so we're going to kind of midway restart. I'm going back a couple of slides. A successful IPO candidate will have consistently high growth in an industry that is highly scalable. They're going to have strong earnings over the last 3 to 5 years with audited financial statements. These are all things that are important. The various stock exchanges, whether it's the New York Exchange or the NASDAQ or any of the others, they all have their own individual requirements. And so it'll vary a little bit depending upon where you're wanting to go public. But generally speaking, you need about 10 years of experience. You need 3 to 5 years of audited financial statements. You need to be in an industry that's got strong growth and strong growth potential for your company, and you need a sound management team. These are essential things. There are advantages that are unique to going public. One of them is certainly maybe the biggest one is the ability to raise large amounts of capital. It is a big deal for your corporation to go public. It certainly increases the profile and the luster of your corporate brand. It does give you access to future financing, presuming that all things that you do are, that you run your business well. So of course the markets are only going to be available to companies that are well run. It gives you the ability to attract and helps you retain key employees. Employees like the opportunity to grow their wealth, and one of the best ways to do that is not just through what you pay them, but also through the options that you give, the stock options and grants that you give them. If you have vesting periods out into the future, that helps to retain them so that they stay with the company so that they get the full benefit of the appreciation and the value of the stock of the company that they help to create. These are all good things. You can use your stock for acquisitions. It's another big deal. Being able to do a stock purchase of another company where you give them your stock in exchange for ownership of that company is only available if your company is public. And then, of course, being listed on the exchanges has the benefit of giving you tremendous liquidity as an owner in the company for your stock. These are all some of the advantages of being a publicly traded company. Now, there are, of course, some disadvantages. One of them is that your founder's stock is typically significantly diluted, but that's generally offset by the fact that that founder stock becomes worth a whole lot more and gives you the ability under certain controlled circumstances to sell some of that stock and gain liquidity. So that's a big deal. Loss of privacy and loss of control. Let's talk about that. Loss of control is really not necessarily a function of how much stock you own. Remember, Steve Jobs owned a major portion of Apple, and the board kicked him out on first go around because he wasn't running the company well enough for the board, for what they were looking for at that point in time. After he matured and he came back, he had a couple of percent in the company, but for the last 10 years, Steve Jobs ran Apple as if it was his private company because he was the dominant force in making Apple successful. And as long as you are the dominant force in making your company successful, you're going to be able to do pretty much whatever you want to. But again, it's all about making your company successful and increasing your shareholder wealth. So that's not really directly a function of how much stock or whether you have controlling ownership of, say, 51% or something like that. You do have to report to the SEC. You have a loss of privacy. You become a publicly visible character, if you will. If you think about what happened to Papa John's when the founder made some idiotic statements, they kicked him out. And when you're the head of a publicly traded company, you have an increased heightened level of visibility, and so you have to kind of watch what you do. Filing expenses are more increased. You have to report to the SEC. There's a lot of costs. You have to pay for audits. You have to have regular reports to financial analysts and to shareholders. You have a lot of pressure for short-term performance. And this can actually lead to a lot of unfortunate decision-making. And this is just a function of how our markets work. For publicly traded companies, quarterly reports are an absolute critical fact of life. And if you're not pretty consistently reporting ever higher earnings and projections for what the future will look like, then your stock prices are going to get hammered. Your analysts will quit liking you, and your shareholders will bail out. Your stock prices will go down, and eventually you'll end up being replaced. That's just the bottom line. So there's a lot of pressure for short-term performance. Now, to do an IPO takes, in the most optimal of situations, about 17 weeks. So that's about 4 months. From the point in time that you get board approval to proceed to do the IPO, by the time you do all of the different things that you need to do, it's going to take you about 4 months. Now, there are plenty of times when something happens and there is a delay, and it can take longer than that 17-week time frame. But in the perfect situation, that's about how long it takes from the time that you decide to go public to the time that you first have your day of first trade. This slide deck will be available for you to review. So this slide is rather detailed. I'm not going to read every aspect of it, but it's an interesting read if you're thinking about going public. So go join the Livestream Lead community so that you can get access to the slide. In a simplified fashion, the steps are that you have to first find an underwriter. So you choose an underwriter, and then you negotiate a letter of intent. I highly recommend that in that letter of intent negotiation, you get a written confirmation of your right to look at the book as it's being built. Now, the book is basically a notepad, if you will. It's a register, a log file, that while you're on the roadshow, doing your roadshow, every time you meet with a potential investment group, they're going to give the lead underwriter's representative who goes on the roadshow with you as the management team, they're going to give an indication of interest. So you might have, let's just say, 100 million shares that you want to sell. I'm just picking a number. And you're going to keep track of how many shares each meeting the person at that meeting says, yeah, I'm down for 10,000 or 10 million shares or whatever. And so that's the book. Now, what you want to do is, as you go around your roadshow, you want to have an oversubscription in the book. But the book is information that your underwriter would like to keep private because they have conflicting motivations with you. Bottom line is, if you know that you're being oversubscribed to the tune that you're selling, you have demand for your stock that's 3, 4, 5 times greater than what you actually have in the way of stock, then you have probably underpriced your opening day share price and your book price, and you can probably bump it by a little bit, maybe $2 to $5, $10 a share. Famously, Facebook did this. They repriced right before they went out, and the underwriters were not real happy about it. But the bottom line is Facebook got a whole lot more money. Let me tell you why the underwriters often don't like you to reprice, and they don't want to share this book demand information, because they like to be able to give shares to their favorite investment funds as a bonus. So if they have an offer that they're representing that's 5 times oversubscribed, they're going to want to give some shares to some investment banking houses that routinely invest with them, knowing full well that they'll buy your stock at, say, $17 a share, which is the book price that they agreed to, and flip it the very first day, literally moments after it starts trading, for $30 a share, making a $13 a share profit. So they'll buy 100,000 shares and make, $13 a share on 100,000 shares. That's $1.3 million profit. This happens routinely. It's one of the ways that the investment banking houses that take companies public are able to reward companies that invest with them, because they like to be able to have a quick sale. So they give profit out. Now, if you bump your price from $17 to, say, $20 a share, you're going to make $3. You're going to make $300,000 extra on your raise from that one individual buyer. My whole point here is when you negotiate your letter of intent, be real stringent about your demand for them to show you the demand of the book. They call it the book of orders that are being built while you're on the roadshow. Okay, then after that, prepare your registration statement, file with the SEC. Then you have to go through a quiet period where you wait to go effective, and then you can go on the roadshow. The roadshow is a 2 to 3 week time when you literally fly around the country. Typically, you rent a private jet, you bounce back and forth around the country, go to city after city. You might start off, say, in Dallas and fly to Houston for a meeting, and then to New Orleans for a meeting, and then up to Omaha for a meeting, and then that's your day, and you hit 3 or 4 meetings in that day. Or you might fly to Houston and have 3 or 4 meetings in Houston, and the next day you might fly to Atlanta. It just depends upon where the investment banking groups are that are interested in investing in your IPO. But that's the roadshow. You spend about 2.5, 3 weeks doing that. You might end up going to London and Berlin for a quick continental visit. Your roadshow is a very hectic time. You're on the road, you're flying. This is not a vacation. It's a very rigorous meeting after meeting after meeting situation. It is fun, but it is very demanding. And after about 2.5 to 3 weeks of that, you're done. And then you just wait for the opening day, and you sell your stock and you start trading your stock. Now, all of that is an expensive and time-consuming proposition. And because of that, the Securities and Exchange Commission realizes that public offerings are expensive and time-consuming, and they're not ideal for all businesses, but they want to make it easy or relatively easy for businesses to gain access to capital. So they have a series of simplifications and exemptions for the registration requirements. And the goal is just to make it easy for companies to gain access to funding. And so the primary rules that and there's quite a few more than this, but the primary rules that you need to be aware of are Regulation D, Rule 504, 505, and 506, and then Regulation CF and Regulation A+. Now remember, Regulation A is for public offerings. So A+ is a new sort of updated aspect of Regulation A. We're going to go through each one of these in sequence, but before we do, I want to make sure that you understand a concept, and that's the concept of an accredited investor. An accredited investor is an investor as defined by the Securities and Exchange Commission regulations, an investor that is considered to be sufficiently savvy to not need as much protection as somebody that's not an accredited investor. Now, the threshold of what was required to be an accredited investor was established about 25 or 30 years ago, and it has not changed, but things have changed since then. To be an accredited investor requires that you have a $1 million net worth, excluding the equity value in your primary residence. That's the net worth requirement. Or you can qualify because you meet one of the income requirements. If you're a single individual, you need to have $200,000 annual income. That's taxable income, 2 years in a row. Or if you're a married couple, you need to have $300,000 of taxable income 2 years in a row. As long as you meet one of the exemptions here, then you're considered to be an accredited investor. Now, again, 25, 30 years ago, these were much more difficult to meet than they are now. 20 years ago, a Quiznos sub sandwich cost $1.99. Today, a Quiznos sub sandwich costs $7. So, it was a whole lot harder to 30 years ago meet these qualifications than it is now, which means there's an incredible number of people that meet the requirement to be an accredited investor. So let's start with Rule 504. This is one of the most common exemptions that are met. You can raise under Rule 504. You can raise up to $1 million a year. Now that's not a calendar year. That's in any given 12-month time frame. You can raise that money from an unlimited number of accredited investors, but all of your investors have to be accredited. Now let me say on this that you only have to get the investor's statement that they are accredited. You do not have to independently verify that, in fact, they are accredited. If they'll sign a statement saying that they know what the requirements are and that they meet the requirements, and you keep that statement on file, you're protected. You do have to comply with state exemptions, which are generally pretty easy, and you are allowed to sell securities that are not restricted. Restricted means that the owner of the securities cannot readily trade them. The reason for having restrictions is to prevent those securities from being traded and effectively creating a market. The whole purpose of these simplified restrictions and exemptions are to allow people to raise capital but not have to go through the public markets. Well, if you allow people to trade their shares, then you might end up being able to circumvent those restrictions. For Rule 504, you do not have to put any restrictions on your securities. So $1 million once every 12 months from an unlimited number of accredited investors is a pretty decent amount of money for a lot of small businesses. The next step up the hierarchy is Rule 505 and Reg D, Rule 505. And it says you can raise up to $5 million a year from an unlimited number of accredited investors. Now, you also can have up to 35 investors who are not accredited. Think friends and family. You do have to have certified financial statements, meaning that they have to have been audited for your company. And you do have to restrict the trading of your securities, which means that the investors that buy your securities have to agree to be restricted on their ability to sell them. Now, that doesn't mean they can't sell them. It just means you're going to be placing restrictions on their ability to sell them. Now, regarding the certified financial statements, there is one giant loophole here. You only need certified financial statements if you have a business that's actually in operation. If you have a brand new business that hasn't started operations and you're raising capital with the intention of starting operations, then you don't need certified financial statements because there's nothing to audit. So you don't really have to worry about that expense, and it can be a major expense to be concerned with. The 35 non-accredited investors means friends and family, Uncle Joe, Aunt Matilda, your cousin Bob, all those people, you can get them in, but you're limited to 35 people that are not accredited investors. The next rule is Rule 506, and Rule 506 basically takes the cap on how much capital that you can raise off. So you can raise an unlimited amount of money from an unlimited number of accredited investors and from 35 non-accredited investors. Rule 506 is a great rule if you need more than 5 million, and so it might apply to you. Rule 506C was the first crowdfunding rule that was put into place, and it has actually been superseded by Regulation CF, which stands for Regulation Crowdfunding. But Rule 506C says that you have no limit on the amount of capital that you can raise. You can use an unlimited number of accredited investors. And the reason I'm still mentioning this is because there are some crowdfunding websites that rely upon Rule 506C. Now, there's a couple, and we're going to get more into this, but there's a couple of different crowdfunding websites, and they operate differently. One of them introduces you to investors and lets you close the deal. Rule 506C applies to those crowdfunding websites. Those are websites like crowdfunder.com and equitynet.com. So you have no limit on the amount of capital, no limit on the number of accredited investors. You cannot have any non-accredited investors. Now, what's cool about this is you don't have to have audited financial statements. You do have to have audited financial statements under Rule 506C. You will need to restrict the securities, but because you're doing crowdfunding, which basically means you're advertising to the public through a website, you must verify the accredited investor status, which means you have to ask your investors to provide to you proof that they meet the accredited investor status requirements. Now, the good news is if they're doing a raise and find you through a crowdfunding site, they're going to understand and know that they have to provide that proof, so they're going to be prepared and willing to do that. So it's not going to be a big deal. Regulation CF is really very interesting. It deals with the ability for you to actually raise money through a public, basically a public interface. It's not an IPO, but it is very similar to an IPO because while you're maxed out at $1,070,000, you have the ability to raise money from an unlimited number of non-accredited investors. And that means people can invest $100, $150 at a time, as long as they meet certain requirements, which are actually very easy for them to meet. And you can actually market to these people through through a variety of mechanisms, including email and social media and other things, to get them to go to these websites like startengine.com, which is a great one for you to be able to utilize to raise money. You do have to use a financial intermediary, again, like startengine.com. Your financial statements for up to $107,000 worth of capital can be just simply management's representations. Now, temporarily, because of COVID, that has been raised to $250,000. So you don't need reviewed financials. You don't need audited financials. For simply having management representation that your financials are accurate, you can raise up to $250,000 from an unlimited number of non-accredited investors. And the securities can be traded on basically a pink sheet equivalent exchange. So Regulation CF is a really interesting way for you to be able to raise money. It actually gets even better through Regulation A+. Do I have a Regulation A+? Actually, I think I have it in just a second. So what I'm going to do is I'm going to come back here. There are really 4 types of crowdfunding, and I'm going to go ahead and give you the 4 types. There is cause-based crowdfunding, rewards-based, debt-based, and equity-based. Now, cause-based is like GoFundMe. So if you have a grandma that falls and breaks her hip, you're going to be interested in cause-based crowdfunding to be able to help grandma get a new hip. Rewards-based are websites like Kickstarter and Indiegogo, where you're basically pre-selling a product that you haven't yet produced in exchange for getting the funds that'll help you produce the product. Debt-based websites like lendingclub.com are basically micro-lending sites where you can get money from people that you would not normally be able to access. If you can't get a loan from a bank, you can go to one of these crowdfunding lending websites where other people can give you money. Now, typically it'll be at a higher interest rate than you could get through a commercial bank, and the websites that handle the interaction will also handle the collections and repayments, typically for a fee. They sort of manage the interface and the payment process to where you repay your lenders. And then, of course, you have equity-based. Equity-based crowdfunding websites, again, come into 2 sort of different flavors, or most of them actually will deal with either a non-intermediary or an intermediary type of raise. I can tell right now that I do not have enough time to be able to get through all of this. So you know what I'm going to do? I'm going to go ahead and come back on Monday and really just dig down into the equity-based crowdfunding websites and do a little deeper dive and show you more about them. I just bit off more than I could chew today. So we're gonna finish the funding and financing segment, starting with equity-based crowdfunding websites on Monday, and then we'll also talk about SBA loans and bank financing and things like that. So before we leave out today, I'm just going to go ahead and close this out. Before we leave out today, I want to talk to you about another thing that's, I think, important, and that is financial advisors that you surround yourself with. There's a guy that I am really impressed with. I know Bob Hampton well. Bob Hampton is a financial advisor for businesses. He's a business financial advisor. And he's both a CPA and a financial advisor, but he specializes in helping business owners plan for their exit. Probably the majority of business owners spend so much time growing their business, and they don't think about and necessarily plan for what that end game is going to look like. And the sooner that you start that plan, the better that end game is going to be. Most small business owners have the majority of their wealth in their business, but being able to plan to extract that wealth either through a sale or some other liquidation event is an important process to begin early. Bob is an expert in this area, and so go to livestreamly.com, click on the Bob Hampton link, Go learn a little bit about Bob, get in touch with Bob. If you don't have this kind of financial advisor in your corner, then you need Bob, or you need somebody like Bob. And Bob's a great guy. So if you think someday you're going to want to sell your business, start that planning process now. Also, go to livestreamly.com simply because you need to create an account and join our community. I will see you on Monday at 3 o'clock. That would be Monday the 16th, 17th, 18th, Monday the 19th. I'll see you on Monday the 19th at 3 o'clock, and we'll finish the section on funding and financing your business. Thanks for tuning in today. See you Monday.